and thank you for joining us for today's web seminar. I am Karen Weisskopf, the Director of Marketing at First Long Island Investors, and I'm joined today by Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer, Philip W. Malakoff, who is a Senior Vice President of Wealth Management and a member of our Investment Committee, and Brian Gamble, Vice President of Wealth Management, also a member of our Investment Committee. Before we begin, I want to take care of a few small logistical items. First, all participants are currently in listen-only mode. Second, after the team delivers our presentation, there will be time for questions and answers. If you have any questions, please feel free to type them into the question box at any point during this session. You do not need to wait until the end. We also have some additional members of our Investment Committee on hand to participate in that section. At this point, everyone should see a slide that says today's speakers. If you're not seeing this, please type something in the chat area and we'll do our best to help troubleshoot. And finally, our General Counsel has asked that I remind you, today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. I now hand it over to Bob.
Thank you, Karen, and good afternoon and Happy New Year to everyone. As the quote says, anything is possible and the unexpected is inevitable. Proceed accordingly, and I will also add the word carefully. One could never have expected that oil would drop some 70% in the last year and a half. Or perhaps one would never have thought that interest rates could stay at near zero from a federal funds rate standpoint for a number of years, something that was very unexpected. And of course, global terrorist activities confronting many nations with many deaths is also something that years ago we would never have expected. All of this shows that anything is possible and the unexpected is inevitable, and we therefore have to act accordingly in representing you. Today's agenda will discuss 2015 in summary because it was a difficult yet interesting year. We'll talk about drivers of volatility, a subject we have spent a lot of time discussing in our last webinar, mid-year 2015, and in our quarterly letters and in our thought piece. We'll also talk about some positives, expectations for 2016, and our approach to 2016 in representing you, our clients, from an asset allocation standpoint. And finally, we'll be happy to answer any questions and hopefully give you answers that give you some comfort going forward. If you look at this slide, it's 2015, and it's a summary of how the stock market, defined by the S&P 500, performed. And it's very interesting. In quarter one, quarter two, into the middle of quarter three, things were pretty stable, not much volatility. During the course of the year, two things hung over the market. Oil was dropping by about 30% during the course of the year, adding to the decline from 2014. And there was tremendous uncertainty around the Fed raising rates, which finally happened in December. In anticipation of that, if you look at the third quarter, you see a precipitous drop in the market. The first correction that we have had since about 2011. A correction is defined by a market decline of more than 10%. So this was the first correction in many years. It took many investors by surprise. But if you look at the next quarter, you see that based on fundamentals and digesting the impact of the Fed rate increase, and also understanding a bit more about the collapsing price of oil, the market substantially rebounded in the fourth quarter. And then, beginning of this quarter, volatility struck again, and as you read or hear on a daily basis, the markets are declining. So 2015, we saw the first correction. We saw a rally in the fourth quarter. So much of those losses that occurred in the third quarter were made up in the fourth quarter. And you'll hear as a theme throughout our discussion, and in anything we ever write to you, that being a long-term investor, being patient, focusing on quality and fundamentals pay off in the long term. If you look at this next slide, which looks confusing, but I'll try and make it easier to understand, it is a slide about volatility. And it goes back to 1982, and it shows the number of days in a year when the S&P rose or fell by more than 1%. And as you can see, if you look to the right-hand side of the chart, in years 2013 and 2014, and even into 2015, there was less than average volatility. Over a year ago, we started writing in our quarterly letters, in our discussions with our clients, and in our thought pieces, and in our webinar mid-year, that we expected volatility to come back. And it hasn't disappointed us. And that's why our thought piece recently was entitled, Welcome Back Volatility. We'll get to how the markets react during periods of volatility, but this slide is an indication that volatility has returned, and despite the fact that we had below average volatility in 2013 and 2014, last year it returned. And if you look at the little numbers to the right-hand side middle of the page, in the first half of 2015, we only had 47 days when the market was up or down by more than 1%. In the second half of 2015, we had 72 days of this significant market volatility. And to reward us going into this year, 18 out of 19 trading days thus far in 2016 have had ups and downs of more than 1%. So there's no question that volatility is back with a vengeance, one could say, but that in and of itself should not scare us if fundamentals are intact, and we'll talk more about that. But the point of this slide is the days of less volatility for now are over, and we as investors have to learn to live with it and be able to navigate it well. If you look at the next slide, it shows that market volatility coupled with markets going down is not unusual. If you go to the left-hand side of the slide, you'll see that in July, 2010, the market actually decreased by 16% and then recovered. In October of 2011, the market dropped 19.4%, almost to a bear market, which is defined by a drop of 20%. And yet the market recovered. In June, market was down about 10%, not quite correction territory, but nevertheless it went down. And then June of 2013, the market was down almost 6%. October 2014, the market was down 7.5%. But as you can see by this chart, the market would go down, but it would come back, again based on fundamentals, which we'll discuss later. And then finally, August 25th, 2015, the market, defined by the S&P 500, dropped 12.4% over a period of time, which reflected the first correction that we had had in a number of years. Markets climb walls of worry and volatility. And we as investors who have been doing this at First Long Island for more than 30 years understand that. And part of our job is to explain it to all of you, our clients, so that you can weather the storm and navigate these storms as they occur, as long as fundamentals are intact. On the bottom of the page, you'll also see the VIX index, which is a measure of volatility. And as you can see at different times, based on different circumstances, flash crash, Greece going out of business, the United States Treasury bonds being downgraded, Europe in a double-dip recession, taper tantrums based on what the Fed was going to do, a global slowdown, an Ebola epidemic. Different things create the wall of worry. This is not new. We've been doing it for many, many years here, and there's always been this wall of worry creating volatility, which can lead to temporary downturns in the stock market. So bull markets climb a wall of worry and a wall of volatility. We're used to that, and you as investors and clients of ours are also used to that, but you know if you stay the course over time as long-term investors, we've done pretty well for you and you've done pretty well. I'd now like to turn over the presentation to my partner, Brian Gamble, who will go into some of the reasons for volatility to give you some more information on each of the reasons we think there is this greater volatility.
Thanks, Bob. Okay, so we're going to cover a number of causes of volatility over the last year or so. And one of the biggest drivers so far of volatility recently has been the steady decline in the price of oil. As seen in the chart on the left-hand side, the decline in the price of oil of 72% seen over the last 19 months approximately mirrors the decline seen during the 2008 financial crisis of 68%. However, we are not in a recession. This decline is mainly due to oversupply, as global production has grown faster than consumption, as seen in the table in the upper right. And notice that U.S. production has grown significantly, and the U.S. is also now the swing producer globally. OPEC has not maintained control over the price of oil, as it has historically, because the Saudis are using the price of oil as a political tool to hurt the economies of Russia and Iran, as well as U.S. producers, by not capping production quotas. These economies require a significantly higher price of oil to balance their budgets. In response to the oversupply, production growth has slowed elsewhere. The U.S. rig count has fallen significantly due to the relatively short amount of time it takes to shut in U.S. shale production as inventories have grown. You can see this in the chart in the bottom right-hand corner. The oversupply is expected to continue through 2016 and 2017 as more production continues to be shut in this low oil price environment. This will continue to remain a source of volatility going forward. The second driver we'll cover today is China, specifically the Chinese economy and the stock market. Chinese GDP has been on a decelerating trend since the most recent peak in 2010. The economy is transitioning from an investment-led industrial economy to a consumption-driven economy, which has been bumpy. The investment-led portion of the economy has slowed while the consumption portion has held relatively steady. This transition is not yet complete and will continue to be a source of volatility. However, the second largest economy growing between 4 and 5% is still constructive. The Chinese stock market has been volatile with significant swings. During the first half of last year, the stock market was up 122% through June 12th. From there, the stock market has fallen 48% through the end of January. You can see this in the chart in the bottom left-hand corner here. During this slide, the government has attempted to intervene to stabilize the market, but only seems to have exacerbated the problem up to this point. Putting all of this in perspective, China makes up a relatively small percentage of U.S. GDP, less than 1% of nominal GDP. The large swings in the market as a result of news out of China seem overdone when look at these statistics and are most likely driven by fear and emotion. Headline news out of China will continue to be a driver of volatility as their economy transitions. The next driver of volatility we'll cover is interest rates. The Fed's interest rate policy has been a driver of volatility over the past year and will continue to be one as we progress through this tightening cycle. After 7 years of 0% interest rates, who could have thought that, the Fed finally increased rates for the first time in December 2015. This cloud was finally lifted but replaced by a new one as the pace of rate hikes is closely monitored and remains data dependent. The Fed has suggested its interest rate increases will be moderate and gradual, but uncertainty remains in the market. There's a clear divergence between where the Fed and the market expect interest rates to be in the future, which can be clearly seen in the difference between the red and gray lines on this chart and can be expected to drive future volatility. Finally, the last piece we'll cover is terrorist activity, which will continue to be a source of volatility. This slide shows terrorist activities in the U.S., or those with more than 50 killed around the world, including recent senseless civilian deaths in both Paris, France, and San Bernardino, California. The number of attacks in aggregate across the globe in 2015 is shocking and worrisome. Geopolitical concerns, including a mounting threat from ISIS, Iran's nuclear ambitions, and Russia's increased role in the Middle East continue to be alarming. These acts and the threat of these acts creates the potential for more volatility and investor hesitancy to take on risk. That said, these events typically have a short-term impact on the market and have little impact on fundamentals. I will now turn it over to my partner, Phil Malakoff, to cover some positives we see today in the market.
Thanks, Brian, and I'm happy to talk about some of the positives in the investment landscape. So I'd like to start with the U.S. economy, which continues to advance. It's advancing in a slow but sustainable fashion. And on this slide, we have 3 charts that show why that is. So the chart on the top left corner shows GDP growth. And over the last 50 years, that has averaged 2.9%. Recently, last year in 2015, it advanced by 2.4%. The same number advanced in 2014, also 2.4%. And expectations are for between 2 and 2.5% in 2016, according to the many economists that we speak to. The chart on the right shows employment, which is improving. And you can see that the private sector has created 12.8 million jobs since the recession ended. And that's more than the 8.8 million that were lost during the recession. Over the last 2 years, an average of 240,000 jobs have been created per month. This is definitely showing some growth. And the unemployment rate, which topped out at 10% in October 2009, has dropped to 5% currently. And we're looking forward to seeing more employment news coming out this Friday. The chart on the lower left shows CPI, or inflation. And the average CPI rate has been just over 4% over the last 50 years. But recently, it's been well below that. And in 2015, inflation was barely positive, up much less than 1%. So, in summary, the U.S. economy is showing strength. We're creating jobs, and inflation is not dampening growth. Consumers are doing well as well. So we have 2 charts here. The one on the left shows consumer sentiment as measured by the University of Michigan. It's a very popular survey that comes out once a month. And you can see that consumer sentiment has grown. It's certainly well above where it was in 2008, 2009, and the dip in 2011. It's currently at 92. It's just below its post-recession highs. Importantly, consumer debt has fallen from its highs, and the consumer continues to delever. They're doing this by paying down their mortgages, paying down car loans, reducing credit card balances. In fact, the only consumer debt that continues to grow are student loans. Corporations continue to do well as well. So we have, in the top left corner, we have a chart of S&P quarterly earnings per share. And you can see post-recession in 2009, 2010, a slight upward trajectory that unfortunately was interrupted in 2015. And the reason for that is twofold. I think we've mentioned it before, but I'll go into a little bit more detail. First, there was a very strong U.S. dollar. And looking at the chart on the upper right, you can see that in each of the first 3 quarters of 2015, the U.S. dollar appreciated by more than 15% against major currencies. And in the 4th quarter, it appreciated by an additional 9.3%. So companies are doing very well in their international locations, but when those revenues and earnings get translated back to U.S. dollars, they're penalized by the strength of the dollar. And this is very important when you look at the S&P 500 revenues. Nearly half, 48% to be exact, of revenues in the S&P 500 are international in nature. And this creates a major drag on S&P 500 earnings. The second negative factor, as Brian mentioned, is the impact of plunging oil prices. And as Brian mentioned, oil has fallen about 72% over the last 19 months. And last year, the energy sector lost 24% of its earnings. And S&P 500 companies, energy companies, make up about 6.5% of the S&P 500. I think this, you can really get a much better sense of this if you look at the chart on the lower left, which breaks out earnings for the S&P 500 with energy included and stripping it out. And so the darker blue numbers or columns show earnings growth with energy companies, the lighter blue without them. So if you look in the second quarter of 2015, you see a differential, a negative growth with energy of 3.2%, a positive growth of 3.8%, stripping out energy companies. And that the difference between the two just grows as we get into the third and fourth quarters. So going back to the chart on the top left, you can see the upward trajectory of quarterly S&P 500 earnings. They grew 6.9% in 2014. They're expected to fall about 1% in 2015. We're still waiting for the last few companies to report before that becomes final. But they should resume their upward trajectory in 2016. Estimates call for 5% growth, followed by 13% growth in 2017. That number is probably a little suspect and will probably be lowered as time goes on. But in summary, corporations continue to do well. They just, last year, were hampered by two major factors. Going to the next chart, we believe that valuations are reasonable. And so what this chart shows is that the average S&P 500 next 12-month PE by CPI tranche shows that valuations are where they should be historically. And so currently, as of the end of the year, the CPI was barely positive, up 0.1%, and the PE was 16.2 at that point in time. So that takes us to the section of 0 to 2% CPI growth that shows the average PE over a 50-year period when inflation was between 0 and 2%, which it is currently, was 15.8. Pretty close to the year-end number of 16.2, and actually, as of last night's close, forward estimates of 15.9, so right on where the number has been historically. And this really supports our contention that the PE multiple is similar to other low inflationary periods and that current valuations are appropriate. At this point, I'm going to toss it back to Bob to talk about our expectations for this year.
Okay, thank you, Phil. So as you can see, there are some reasons for volatility that were unexpected. And as Phil pointed out, there are also some reasons for optimism in terms of how corporate earnings are doing and how the consumer is doing. One point I'd like to make before I get into each of these expectations is that we as a firm have avoided investing monies in commodities like oil because they're very hard to predict. So we have avoided some of that carnage. For 2016, we believe that interest rates will increase very slowly. The Fed began in December. It's pure speculation as to how many modest increases there will be this year. Some say 4, some are down to 2, and some economists are even saying no more increases this year. In any event, we believe rates will go up very, very modestly and very slowly, and that's a good thing. Bonds will provide little, if any, real return on an after-inflation basis, and possibly even a negative return. The exception to that could be high yield, a space that we'll talk about a bit later. But right now, we had an investment committee meeting this morning. To give you an example, the AAA 5-year municipal bond was yielding 1.09%. These are very modest returns, if any at all. Cash, and we know that many of our clients continue to hold on to cash, but complain that they're receiving from their friendly bank maybe 10 basis points or 0.1%. In some cases, even less than that. So cash as a long-term investment has never been particularly good. It's there as a safety factor to help you sleep at night, but it will not provide much of a return, and we don't see any change to that during 2016. As Phil pointed out, S&P earnings will grow modestly. And again, it's our job to do better than the S&P in terms of investing in companies that have better attributes than the S&P. But in any event, the S&P 500 should grow modestly this year, even despite the currency issues or headwinds that Phil raised, and despite earnings from energy-related companies being quite poor. A major factor will be housing, which we believe will remain reasonable and contribute to an expanding economy. It's a very important component to the GDP growth that we expect to be around 2% for the year. Oil will bottom out at something close to the current level. As of a little while ago today, oil, West Texas Intermediate, was below $30 a barrel. We can't predict with any precision just how much further it will go down, but we believe, based on the charts that Brian showed and the work that we've done, with rigs being cut back, with foreign countries needing a much higher price to balance their budgets, that market forces will stop the oversupply and eventually balance will come back and oil will bottom out at something close to this level and then perhaps slowly increase from there. Inflation will remain reasonable at probably less than 2% or no more than 2%. And that's very helpful, especially when you're not earning very much on your cash or bonds. Congress will attempt to tackle tax reform. The United States has a corporate tax rate of 35%. That is among the highest of developed nations in the world. And it makes some of our businesses not as competitive against foreign companies as they should be. Both sides of the aisle, Democrats and Republicans alike, realize that this is a hindrance, and this keeps monies overseas and keeps jobs overseas. And we believe sometime this year or next year, this will be tackled by Congress in a bipartisan fashion. Excuse me. The fight against Islamic terror will intensify. The chart that Brian showed is shocking, it's alarming, and it's scary. To think that you can go to Paris or any place else and be confronted with a terrorist attack is something that no rational country should want to see. And we believe there will be a growing coalition of countries led by the United States that will intensify its attack against Islamic terror to rid the world of those heinous individuals who would attack innocent civilians. As Brian pointed out, we believe the Chinese economy will continue to slow. The days of that economy growing 6, 7, 8% are probably behind us, as well as the transition that Brian mentioned from an infrastructure, manufacturing type build out to more consumer and service driven, which actually benefits many of the companies that we invest in. So we expect that China's economy will grow 4 to 5% this year. However, if you read the headlines and watch the volatility in the market, you'd think that China was in some sort of major recession. It is not. So we are confident, we believe that the Chinese economy will grow 4 to 5%, and as the second largest economy in the world, that will contribute to global GDP growth. Other emerging markets that are commodity driven, and whether it be Brazil or Canada to some extent, or Australia, they may face recession based on the fact that their raw materials that they produce in those countries are in less demand. That's something to watch. A major point for us, and it's been mentioned before, we do not believe the United States faces a recession this year, or for that matter, in the immediate future. Historically, it takes 5 years from the time of an initial rate increase by the Fed for there to be a recession. So we are confident that the United States, even growing modestly at 2% GDP with a strong consumer who should at some time benefit from cheap oil prices, we are not facing a recession. And that's critical to global GDP growth. A presidential election will contribute to uncertainty. 2016 is a major election year. A new president will be elected. Senate control may be up for grabs. There will be many local elections. So throughout the course of this year, and it started last night in Iowa, There'll be much conjecture and speculation as to which party will win, who the nominee will be for president, and as you know, there are quite different philosophies between Democrats and Republicans, which will be battled out during the course of the year. This will also create some uncertainty. But historically, in the fourth year of a presidential term, towards the end of the year, the market gets better. And all of this will contribute to more volatility. So it's quite obvious to us that volatility is here to stay, and we, as your wealth managers, have to help you deal with it. The way we do that, this is a slide that you should be familiar with, is to maintain a diversified portfolio with prudent asset allocation customized for each client. Every client is different. Every client has different circumstances. Every client has different tolerances for risk and different goals. Excuse me. So we try and address that by deploying your capital and ours side by side with you. As you know, we invest side by side in every investment with you in 4 baskets: security, defensive, traditional, and private investments. In the security investment area, it's cash and fixed income. And at this point, we have a modest underweight to this allocation because the returns appear to be very inopportune and not very attractive. Our defensive strategy basket has 3 strategies: hedged growth, dividend growth, and multi-strategy hedged investments. And there, because of the volatility and the fact that things are reasonably priced but not cheap, we have a significant overweight or an overweight to these defensive strategies in this basket. In the traditional equity area, where we have diversified equity, large cap growth, and large cap value, we're modestly underweighting. And in private investments, real estate, private equity, we utilize as appropriate based on suitability for each of our clients and the opportunities that present themselves. These 4 baskets represent how we allocate your capital in concert with you and how we believe we can best navigate and weather the volatility that we faced in the past and we will continue to face in the future. And we hope that this will give you the ability to sleep at night, and by being properly allocated among these 4 strategies, or 4 baskets and many strategies, you'll sleep at night, you won't act emotionally, and make the mistakes that typical investors do, which is to sell because of fear and buy when things are too high and greedy, but we'll talk more about that later. And with that, I'd like to turn the program back to my colleague, Phil.
Great. So I'm going to talk about our approach to 2016 by basket. So let's start with fixed income, which we are recommending to clients that they continue to underweight. And why do we do that? Well, we, as we explained, expect rates to rise somewhat slowly this year. And all other things being equal, higher rates mean lower bond prices. And if we look at the chart that's on this slide, you can see that rates just really are not very attractive. The blue line is the 5-year municipal yield. The red line is the corporate yield, tax affected, so after taxes. And you can see they're both, below 2.5%. They remain very low. They're barely above inflation. They're just very unattractive. The green line, which is high yield, is a little bit more interesting. It could provide an opportunity. You can see throughout last year, the yield on high yield actually went a little bit higher. And we're currently investigating an opportunity, and if it makes sense for certain clients, we'll be in touch shortly. But as we do with all our investments, we do a deep due diligence process. Our strategy to crafting bond portfolios is to keep maturities and durations relatively short. As with short duration bonds, they won't react as much to interest rate moves, and we feel that's important for our clients and their bond portfolios. Regarding our defensive basket, we continue to recommend to our clients that they overweight this area. This is a recommendation we first made at the beginning of 2014, so it's been 2 full years now. and it's been been good advice to our clients. It's helped protect during some downswings, as well as help them participate when things are going well. And given our belief that there will be increasing volatility going forward, we believe this area will be very productive for clients. So defensive strategies tend to have three characteristics. One, they mitigate volatility. They tend to have lower beta, lower standard deviations than the broader market, so valuation swings should be dampened or less. The second is they minimize downside capture. So what is downside capture? Downside capture is a measure of correlation for a strategy to its benchmark index. The lower the downside capture, the better it protects wealth during market downturns. Additionally, we expect defensive strategies to capture a significant portion of market appreciation, and that has been the case over the last couple of years as we've overweighted this basket. So what are some examples of strategies in a defensive basket? Well, one example could be a hedged growth strategy. And simply put, this is a long-short strategy where the strategy is long one item and short another. An example could be being long Facebook, which is a social media company which is growing more than 30%, and being short Twitter, which is another social media company. And that trade actually would have done very well in 2015. But many hedged growth strategies could be long equities and short derivatives. Another example would be our dividend growth strategy, which has a stream of growing dividends which provide a defensive nature to this investment. And we would expect the dividends in the strategy to grow between 7 and 10% per year. In fact, last year, the dividend growth for the companies in this strategy was 9.5% on average, and the current yield in the strategy is 3.1%. Another example of a defensive strategy is a multi-strategy hedged investment. These investments are typically much less correlated to equity markets. Examples could be risk arbitrage, distressed credit, or credit spread trading. Regarding traditional equities, we are recommending that our clients maintain an allocation. Now, a question we're getting from some clients is, well, you've always told us when rates go up that equities shouldn't. But the chart on slide 20 actually shows that over the last 25 years, there have been 6 periods where rates have been rising. And during 5 of those 6 periods, there have been positive S&P 500 returns. And during 3 of those 6 periods, the returns have been more than 20%, so quite extraordinary. And I think we should also mention, it's important to note, that historically a recession has not occurred until about 5 years after the first interest rate increase. And since the first increase was about 6 weeks ago in mid-December, that certainly gives the economy a lot of time before a recession could be expected. As investors, First Long Island Investors focuses on high-quality companies. We believe in concentrated portfolios and high active share, and we believe this combination can result in decent investment gains. We believe during this period that smart stock pickers can find opportunity, and we believe that will be the case going forward. And I think it's also important to mention, and Bob mentioned it earlier, that we are long-term investors. We're not going to let day-to-day fluctuations of volatility influence our long-term recommendations to clients. We believe investing is a marathon, not a sprint. I'm going to ask Bob to discuss the next slide.
Okay. Just quickly, this slide is just a snapshot of how the traditional average retail investor takes money out of the stock market and into the bond market at probably inopportune times. To Phil's point, over long periods of time, our clients have made solid returns in equity markets despite the wall of worry, despite volatility. mutual fund investors historically tend to not do as well as their underlying mutual fund because they sell on fear and they buy on greed. And this chart will show you that, for instance, if you look to the right, in the third quarter of 2015, there was a substantial outflow from equity mutual funds, only to be followed by a very strong fourth quarter. If you look at the third quarter, if you go to the left-hand side of the chart, and you look at the third quarter and fourth quarter in 2011, same thing. Investors fled the equity markets, added money to bond markets, and the stock market did reasonably well. The point of this slide is stay the course if you're invested in quality, good businesses. Remember, we're not investing in a stock symbol. We're investing in an underlying business that we view as being very attractive. So the point of the slide is don't sell out, call us, be patient, be long-term investors, and in most cases, you will be rewarded. In summary, it's fair to say that volatility will continue. We also believe that corporate earnings will continue to grow, but at a slower rate. But the increase in corporate earnings is the underpinning or the fundamental that really drives stock prices. So given, as Phil pointed out, we tend to be more concentrated, we invest in companies that are doing reasonably well or quite well, and we believe that over time their share prices will follow the growing stream of earnings. Valuations, even with the downturn, are reasonable but not cheap. So we've got to be careful in terms of the companies that we pick or the managers that we utilize, they pick. Current yields on bonds and cash appear to be unattractive. Long-term investors should remain in the equity markets, focused on investments in solid companies with reasonable valuations. And our job is to make sure that we invest in something better than the average company. Prudent asset allocation with an overweight to our defensive strategies is the best course for most of our clients in these volatile times. And we, as you know, look at each of your asset allocations on a quarterly basis to make sure that they're consistent with how we see market opportunities, and therefore we make changes accordingly after consulting with you. Thank you very much, and now we will go to questions and answers.
Thanks, Bob, Brian, and Phil. We've gotten some questions already, and we'll start with those. Please, there's a questions box on your screen. Please continue to send your questions in. One question we've received so far is, can you see a point being reached where low oil prices will have a positive impact on the economy?
The lower oil prices, where gasoline and heating oil have declined by 70%, has impacted virtually every consumer. The U.S. economy is made up of approximately 70% consumer and 30% business. So we truly believe that the cheaper oil prices that we're all facing and that appear to be here for a reasonable period of time will benefit the average consumer, not just in the United States, but in other countries as well. China imports oil, so the Chinese are benefiting from that. Japan imports oil, the Japanese are benefiting from that. Europeans import oil, so they're benefiting from that. But interestingly enough, at this point, much of those savings are being saved by consumers, not being spent, or they're deleveraging their personal balance sheets. So yes, we do expect that cheaper oil prices will benefit a whole bunch of us, many consumers and some businesses as well. The offset being that obviously those companies that produce oil are not doing well.
Great. Hopefully that answers the question. I sure think it does. Another question we got is, do we think that high volume trading is an additional source of volatility?
Phil, you want to take that?
There have been a number of studies about that, and I know the SEC is looking into it. I would certainly say that high volume trading, while it does create additional liquidity on an intraday, intra-hour basis, it does create a lot more volatility. the quantitative trading, there's no human feel to it. There's no touch to it, so that it's just very mechanized, and there's no emotion to it. And it was in when was that flash crash? That was in 2014, right? That was a period where that type of trading really took control of the market for a very short period of time, and stock prices went down very significantly intraday. They did bounce back, however, for the most part by the end of the day. So I would say, if you're a short-term trader, yes, it creates a lot more volatility. That's not the type of investing that we do at First Long Island Investors, and in fact, it may actually create more opportunity for us.
Just to add one point to that, flash trading or high-frequency trading has nothing to do with the fundamentals of the companies that we typically invest in. So it's a short-term, to Phil's point, volatility. We probe each company to make sure if there's any movement in its share price that it is or isn't based on fundamentals. And we go back to fundamentals, and we would ask you to look at the fundamentals of the companies you invest in before you get overly concerned about any volatility from short-term flash trading or high-frequency trading.
Great. So we have another question that's asking us to give an example of how an asset allocation has helped investors, and I guess most specifically the investors that are clients of ours.
Well, that's an easy one. Last year was a very interesting year. Despite the market only being up 1%, or the Dow being slightly down, NASDAQ being down, there was a divergence of performance between large cap growth companies and large cap value companies. Many clients that come to us tend to be overweighted to value, and last year growth outperformed large cap growth outperformed large cap value by 1,000 basis points approximately. So what we've done with clients in recent years is made sure that their asset allocation within the traditional equity basket, or for that matter, even within our defensive equity strategies, we have opportunities where they're more growth-oriented, where companies, to use one, Phil mentioned Facebook, it's a company that we invest in, it's a large cap growth company. So by giving our clients an allocation to larger cap growth companies, they participated in an asset class that performed very well last year, as opposed to large cap value companies, which are made up by energy companies, financial companies, and industrial companies, which for many of the reasons that we discussed earlier, performed quite poorly. So that asset allocation decision by us, or suggestion to our clients, helped many of our clients.
Great. So the next question goes back to the discussion we had, I think, once or twice around the recession. So we understand that history would say that you don't typically have a recession for a number of years after interest rates rise. But is there anything else going in the market that leads you to be convinced there is not a recession in the immediate term? I'm going to hand that one to Ralph Gillespie.
Hi, everybody. Typically, you don't see what happened in December is the Fed started on their path to raise interest rates. Much to the dismay of Christine Lagarde, who runs the IMF, and Mario Draghi, who runs the ECB, who were pleading with our Fed not to raise rates because globally the economy was a lot slower than the U.S. economy. The one indicator that I think you can follow that is almost a surefire predictor of a recession is the yield curve. History has shown that a recession will take place sometime between 6 months to a year after the yield curve inverts. What do I mean by that is when short rates are paying a higher yield than long rates. We're nowhere near that today. If you look at our rates today, we've got a yield curve that's flattened a little bit, but it's nowhere near inverted. So once you see an inverted yield curve, you can almost bet that you're going to have a recession 6 months to a year down the road. So I would think, at least in my own opinion, we're a couple years away from that. and I don't really see anything on the horizon to indicate that we're going to be in a global recession. Europe is slow, but the growth, they're coming out of it. China is slowed down. The U.S. is growing, but maybe at 1.5–2%. But the yield curve is there. It's not inverted, and until you see that, I wouldn't worry too much about a recession.
Great. Thanks, Ralph. And I think we have time for one more question. So thank you for all the questions that have been sent in. There are people that are saying that as January goes, so does the market. What do you all think the rest of 2016 holds?
Well, certainly January was an ugly month for the equity markets. There's no disputing that, and it probably was the worst start to a year in history or in many, many, many years. I think statistically, the market is down 70% of the time that January is down, but 30% of the time it's up. As I mentioned before, in a presidential year, fourth year of a presidential term, the market is modestly higher and it's back-ended. We believe that if earnings continue to grow and the slide of the dollar is stopped and it seems to have leveled out, there's a good chance that the fundamentals will take over again, and growing earnings in a reasonable economy can lead to better stock market performance. And again, we've seen great volatility where the market can be down 1 or 2% and the next day it's up 2 or 3%. So the uncertainty of the Fed, the uncertainty of oil, the uncertainty of China will work its way out over the course of the year. So we believe we're investing in concentrated companies, as Phil pointed out. They seem to be doing very well from an earnings standpoint, and we believe come the end of the year we'll be happier than, let's say, we are today.
Great. Well, Bob, Phil, Brian, Ralph, thank you so much for all the insights today. To everyone on the phone, thank you so much for joining us. We hope you found the session interesting and insightful. For the clients of ours that are on the phone, I just want to remind you that our investment committee is always available to discuss your individual asset allocation. Just give us a call. And if I could ask, when you close out of the event, there will be a quick 3-question survey, and your feedback would be most appreciated as we plan future events. We are planning for another event later this year, and we want to make sure that we're providing content that helps all of you. Thank you so much, and have a great afternoon.